Hi, my name is Bjork, and our role is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings program. Thanks for taking a few minutes to tune into this quarter's Student of the Market update. The goal of this series, as always, is to inform the important financial decisions being made both in your workplace retirement savings program and beyond. So with that, let's get started and take a look at the first quarter so far of 2023. We're going to begin by looking at the old market adage, so goes January, so goes the rest of the year. And we'll take a look at the slide here, and we'll see that when we have a strong start to January, and we're up with the S&P 500 up over 6.3% for 2023. We can see that when we start the year with a strong January, history has shown us that the next 11 months on average are up 12.5%. Whereas if we start the year with a negative January, then we look and we see that the market return over the next 11 months has averaged 7.6%. So a healthy difference between the two, and maybe something to this old market adage. And we can also see the probability of having a bad year or a negative year is also potentially correlated to that strong January, right? So we look and we see if we start with a positive January, that only 21% of the time have we ended up with a negative year, versus if we have a negative January, that number's 39%. So a healthy difference between the two, and interesting to see if that holds up this year. So good start to the year through January. Let's take a look, though, and look back at 2022, and not to bring up painful memories and belabor the point, but these slides have been updated with all of 2022 data, and I think it's important to acknowledge and take a look. So, so with that, if we look at a balanced 60-40 portfolio, we see literally fourth worst year ever, right? And we look at some of the other time periods, that's some pretty rarefied air, right? Great financial crisis. We see the bursting of the tech bubble. We see the Great Depression in there, 73, 74. So, really a tough year for the average, retirement plan or, balanced portfolio investor. And when we look and we think about that, we say, okay, well, that was the balanced portfolio. What about other asset classes? How did everything else do? Well, if we take a look and we see that of the asset classes that Morningstar covers, 94% of them lost money and had a poor year last year. Interestingly, that's the same number as in 2008. So, when we look at this chart here, we see, that a positive that we can take from this is that one is that the poor years, when it felt like nothing was working, the time periods tend to be pretty short, and the following years historically has seemed like everything's been working, right, and tend to be a little bit longer. So again, we'll see how that holds up for this time period, but certainly if history can be our teacher, that is something that we can keep an eye out for. Finally, volatility, right? So when we've looked at the volatility chart year to date, we've updated it here with all of 2022 numbers, and if we look, we see we're at 46, or we ended with 46 greater than 2% market moves, up or down. What's really interesting is when we look at this, we see that of those 46, 23 were up, greater than 2% market moves, 23 were down, greater than 2% declines in the market. And this is a visual illustration of why it is so hard to time the market, right? The good days and the bad days, they tend to live in the same neighborhood. So it's really hard to time the market. Another great reminder, right, that we need to stay invested and we need to stay disciplined, and that it is incredibly difficult to time the market, right? The market does not like uncertainty, and we have a lot of uncertainty in the world, right? And we're seeing that in the form of volatility and the market trying to find direction. So what has history shown us? We've talked about the good start to, through January. We talked about the really challenging, historically challenging year last year. What has history shown us in terms of some strategies that we can deploy, or themes that we can be thinking about as long-term, investors and investors for retirement? Well, first, we updated this slide here. Those who are familiar with the series will recognize it. Diversification, and now we've included all of 2022. The punchline here is that diversification never feels good, but if we look at the bottom line here, we ended up being better in a smoother ride than the S&P 500 for this entire time period. So diversification rarely feels good. However, it is a strong visual illustration here that a good strategy can be winning more by losing less, right? And so when it doesn't feel good, it's important to take a step back and really think about how has being diversified served us over long periods of time, even if it doesn't feel good. What's another strategy we can consider, or another theme? One is being a contrarian. So if we look at the chart here, these are the market flows, and if we look and we see what the market has done following net years with negative flows versus years with historically strong inflows, we see that being a contrarian has historically been rewarding, right? So what I mean by that is if we look at years following market outflows, we look and we see that, on average, the following, the following 12-month period, investors have ended up over 22%. Right? Whereas if we invested and looked at 12-month periods following record inflows, it's actually a negative 3.9%, right? So something to think about. We had modest outflows last year. So as an investor, not following the crowd and being a contrarian can be a theme that in an environment like this is certainly one to keep in mind. Another theme to consider is emerging markets. And I bring this up, and please keep in mind, within the context of a well-diversified retirement plan portfolio. Emerging markets are a very volatile asset class. But if we are, thinking about rebalancing, or we are thinking about including emerging markets as a, small portion of our diversified and balanced retirement savings portfolio, then let's take a look at year to date. Even though emerging markets have had, a positive January, the 5-year number is still hovering around a minus 1.5% on an annualized basis. And what's really interesting is if we look historically, every other time period where the emerging markets have had a negative 5-year number, the next 5 years returned an average of an annualized 17% per year for 5 years. So, very strong indicator with the trailing 5-year being negative, that it might be something to consider if you're looking to rebalance and/or include emerging markets as part of your international allocation in a diversified portfolio. So, again, a very volatile asset class, but certainly something to keep in mind as a long-term investor. So, what's the final theme we should keep in mind? Just being, if we take a look at this chart here, having a long-term focus, right? Long-term perspective. Every one of these periods here in yellow is a recession. Every one of these events that's called out on the slide is a reason to sell. Every one of them. But if we look at what happened for an investor who stayed disciplined and stayed invested over a long period of time, we can see that is the investor who historically had been rewarded for that discipline. So, with that quick update for this quarter, I'm going to put some important disclosures up on the screen. And as we're looking at these, thank you for your time. Thank you for joining us for this quarter's Student of the Market update. And again, as always, the goal of this series is to inform the important financial decisions, both in your plan and beyond. We thank you for your time, and we look forward to our next conversation. Thanks so much. So long. Bye.